Welcome back to Investing Talk Podcast.
Today we're looking at American Battery Technology Company.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're really going to be digging into this one, looking at their spot in the lithium-ion battery recycling market.
And really the core question is whether their proprietary tech gives them a real, a long-term edge.
Absolutely. Because what we're seeing when you first look at the company is this massive, deliberate strategic shift. It's a really powerful signal.
It is. They've basically gone all in on recycling.
Right. If you look at the Q1 2025 numbers, the battery recycling part of the business just exploded.
Yeah.
It now makes up 89% of their total revenue.
89%. And what was it before?
A year ago, it was just 67%.
Yeah.
So management is clearly laser focused on scaling up that Nevada facility.
And that focus is actually paying off, right? We're seeing it in the results.
We are. Q1 2025 revenue hit $1.84 million. That's a 72% jump year over year, which is huge.
Okay, but more important than the dollar amount is how they got there.
Exactly. This wasn't some one-off contract. It was driven by a literal physical ramp-up in throughput at their facility in Reno.
How much of a ramp are we talking about?
They went from processing roughly 1,500 tons per year up to 3,200.
In a single quarter?
In one quarter. They more than doubled their operational capacity in just 3 months.
I have to push back a little here, though. I mean, going from 1,500 to 3,200 tons sounds great, percentage-wise. But, 3,200 tons a year, that's still a drop in the bucket compared to the big global players. Is this real or is it just symbolic?
That's a totally fair challenge. It's definitely not cash flow positive yet, but it's critical for two big reasons.
Okay.
First, it proves the basic mechanics of their process work outside of a lab. And second, this is where we get into the margin improvement and the technology moat.
Right, let's unpack that moat. Because volume is one thing, but in recycling, yield is absolutely everything.
And this is their primary competitive advantage. It's their proprietary hydrometallurgical recovery technology.
And this is what everyone is watching so closely.
It is. Third-party validation shows this process gets greater than 95% lithium recovery efficiency. That number is it's astounding.
Okay, for our listener, put that in context. How big of a lead is that 95% compared to the industry standard?
I mean, it's a difference between being profitable and just struggling to break even. Most of their main competitors use what's called pyrometallurgy.
Which is basically just smelting the batteries, right? High heat.
Exactly, a thermal process. And their recovery rates are stuck somewhere between, say, 82 and 85%.
So you're talking about a 10 to 13 percentage point gap. That is massive.
It's monumental. Think about it. If you're processing 10,000 tons of old batteries, that difference means you're pulling out hundreds of extra tons of lithium, cobalt, nickel, valuable stuff your competitors are just burning off into slag.
Over time, that becomes a huge structural cost advantage.
It does. And it's not just the quantity, it's the process itself. They call it a closed-loop, zero-waste aqueous process. And that's not just some green buzzword.
Right, it's an economic advantage. Why?
Because it lets them directly recover battery-grade lithium carbonate. The stuff is basically ready to go straight into new cathodes.
So they skip a step.
They skip multiple expensive, energy-hungry refining steps that the other guys have to do to clean up their materials. It's a massive shortcut.
Which explains why they guard that tech so carefully. I saw they have something like 14 granted patents.
14, yeah. Including one specifically for their lithium selective solvent extraction method. It creates a pretty significant barrier to entry for anyone trying to copy them.
And the industry is taking notice.
Oh, yeah. They're already in pre-qualification testing with some of the biggest cathode makers in the world. We're talking about Umicore and POSCO Future M.
When players that big are testing your material, it tells you the quality claims are probably real.
It's a huge stamp of validation.
Okay, so the tech is solid, the initial ramp-up is done. Let's pivot to the financials. They're pre-profit, but are they on the right path?
The path looks very positive. Even with all the spending on scaling up, their operating margin improved dramatically in Q1.
How dramatically?
It narrowed by 1,700 basis points. It went from negative 58% in Q1 of 24 to negative 41% this year.
Wow. So they're absorbing those fixed costs really well as they increase throughput.
That's exactly what it suggests. Successful operational leverage. And management seems confident enough to actually raise their guidance for the full year.
Which is always a good sign. What's the new guidance look like?
They raised the revenue forecast to between $12 and $15 million, up from 8 to 12. And critically, they also tightened the projected negative EBITDA loss.
So they think they can control costs better than they did before.
Exactly. And we've seen a bunch of analysts react to this, revising their own 2025 EBITDA estimates upward by 28 to 35% since January.
Okay, so the optimism is there. But what about the cash runway? They have about $25.5 million in cash, low debt. Is that enough to get them through this scale up?
That's the million-dollar question, or I guess the $25 million question. It's enough for a year based on their operational burn, but not for the big capital spending for phase 2.
Which is why this non-dilutive funding is so important.
It is paramount. They have a $7.5 million non-dilutive grant coming from the DOE's Battery 500 consortium, expected in Q3.
So that's not debt, it's just cash.
Just cash. And it's a total game changer because it covers 65% of the final equipment they need for the phase 2 expansion.
So it massively de-risks their growth plan without diluting shareholders.
Exactly. And that brings us to the near-term catalysts, because the next few months look absolutely packed.
Let's start with the commercial side. There was one data point that really stood out to me.
The Tier 1 EV OEM agreement had to be.
Yes. They're supplying recycled lithium cobalt oxide cathode precursor. But it's the price that's shocking.
Right. The contract is priced 18% above the market spot price.
18%. For recycled material. I mean, is that sustainable? Or is that just a short-term premium because they're a small, high-quality supplier right now?
A fair question. That premium might shrink over time, but the fact they can command any premium right now validates the whole story. It proves major players see their material as superior. The economic moat is real.
And we're seeing confidence signals from inside the company, too.
Oh yeah, the insider buying. Between February and April, the CEO bought 100,000 shares.
Which is his biggest purchase since the IPO.
Right. And the CFO added 50,000 shares. When leadership is putting their own cash on the line like that, you have to pay attention.
And it's not just them. The smart money is moving in.
Yep. Q4 filings showed 2 big new institutional holders, Viking Global and Renaissance Capital. These aren't retail speculators.
And on top of all of this, you have a massive macro tailwind with the Inflation Reduction Act.
The IRA is huge for them. It formalizes a recycling credit that directly benefits their process.
So.
They get a credit of $15 per kilowatt hour of recycled material. Some of their competitors, with less efficient processes, only get 10.
That $5 difference adds up fast when you start scaling up to thousands of tons.
It's a significant government-backed subsidy to their cash flow.
Okay, so let's give the listeners a calendar. What are the key dates to watch over the next 3 months?
3 big ones. First, mid-May, you've got the Q1 earnings report. The consensus is that they'll beat on the EBITDA loss, meaning the loss will be smaller than expected.
And then the big one for their finances.
June 10th. That's the expected disbursement date for that $7.5 million DOE grant. If that cash hits the bank, the risk of a near-term equity raise basically disappears.
And finally,
June 30th, that's when the final equipment for Phase 2 is expected to be delivered. That's the physical trigger that sets up the big revenue ramp later in the year.
okay, we should touch on the rumors swirling around too.
We should. There's persistent chatter about unsolicited M&A inquiries from big European players, and also whispers that the DOE grant could get expanded maybe to $20 million.
But we have to stress, those are unconfirmed. Exciting, but you invest on the facts.
Exactly. So let's talk about the risks, because the market is clearly still very skeptical.
It is. The number one risk has to be pure execution risk. Technology scale risk.
That's it. Hitting 95% recovery in a pilot lab is one thing. Doing it at full commercial scale, 7,500 tons, is a whole different beast. If they can't replicate that efficiency, the whole thesis kind of falls apart.
And there's also customer concentration risk.
Yes. A huge chunk of their projected 2025 revenue, something like 82%, relies on just 3 undisclosed OEMs. If one of those contracts gets delayed, it could really hit their guidance.
And the market is pricing all of this in, heavily. I saw the company trades at, 0.8 times EV to 2025 revenue.
0.8.
Yeah.
While its peers are trading around 3.5 times, that massive discount tells you everything. The market is betting they can't pull off the scaling.
So if we pull this all together, the tech, the premium contracts, the non-dilutive funding, that steep discount, what's the elevator pitch here?
The pitch is this. You have a company with proprietary government-validated tech that lets them charge a premium. They have secured the cash to scale up without diluting shareholders. And because of that, they could be the first U.S. pure-play recycler to hit breaking Bidoof, maybe by 2026.
And getting that potential at such a deep discount to its peers is the core argument.
That's the bullish case in a nutshell.
So for you, the listener, the thing to watch isn't really the next earnings report. It's that Juneteenth date. The confirmation of the DOE grant is the real litmus test here.
Yeah. If that funding comes through, it confirms management can execute on this scaling plan. And then the bigger question becomes, what if this hydrometallurgy process just becomes the new industry standard?
Rendering every old-school smelter plant obsolete by 2030.
It's a provocative thought for the long term.
It certainly is. Don't forget to subscribe to Investing Talk podcast for more analysis and insights into the companies that are defining what's next.